After what's been described as the perfect international financial storm, it now appears that the global financial services sector is emerging from turmoil. The future of global finance and the avoidance of past mistakes is now firmly top of the agenda for business leaders and policymakers alike. And so when an international financial summit was held in Dublin, Ireland, it was only natural to draw the focus of expert minds. And Ireland on Business went along to find out more.
In financial centres worldwide, issues such as regulation and the future of the sector provoke often heated debate. With the roll call of financial majors from the US, Europe and Asia operating in Dublin, the experience here is similar to that of other leading financial centres around the world, as stakeholders seek to understand the lessons to be learned from such a major upheaval.
Well, there are many lessons. One is that one of the causes of this crisis and bubble was easy money and easy credit. So policymakers, monetary policy, central bankers were asleep at the wheel. Secondly, regulators and supervisors were also asleep at the wheel. They believe in self-regulation, in market discipline, internal risk management model, things that don't seem to be working. Three, there was too much greed, risk-taking and leverage in the financial system.
But if the crux of regulation is to increase confidence, unity seems to be harder to achieve. And where many EU states have been unequivocal in calling for more regulation, the US and UK have been more ambivalent. And this lack of consensus may expose a fault line in international finance.
I think it's pretty clear that it is coming from the US, that the agenda, which is basically to strengthen the existing system, is now being defined by the US Treasury principally and Congress, and Europe has lagged somewhat behind. There have been some important developments in Europe, particularly the recognition that we do need a EU-wide regulator to complement the European Central Bank. But at the moment, the divisions within Europe on how to manage the financial system, what this crisis caused, and the unwillingness of parts of Europe to fundamentally transform their banking system, notably in Germany and France, will make it very difficult for the EU to take a lead.
Closer to home, intra-European regulation has also been found wanting, and without a pan-European regulatory framework, Europe's financial services sector may look more like a patchwork quilt of national interest, and less like the single market that has been at the core of the European project.
So big issues are A, how do you regulate capital in the banking system, in banks? And this is very difficult, capital and liquidity, because increasingly you have to look at capital and liquidity in the same framework. I think there are huge yet unanswered questions on this, not only at what level of capital, but more fundamentally at how you measure it and how you make sure that the regulation you put in place will not be circumvented the way it has been in the years leading to the crisis. B, who should be in charge of monitoring this? Is it the central bank? Is it a separate authority? There's a huge scope of opinions here, and I don't think we have a clear answer to this.
While Ireland's domestic economy continues to endure a substantial realignment, it is the strength and scale of its internationally traded sector and international finance that is seen as critical to its return and resurgence.
Well, financial services industry, the international one, was established about 20 years ago, and we now have over 250 international institutions in banking, in investment management and insurance. And clearly when companies are looking around the globe, there are a number of things that attract them. Talent is very important, the level of technology capability, the tax environment, and for all of these important factors, the track record of successful implementation by a number of financial institutions really scores well in the assessment of Ireland.
While regulation of the financial sector is seen as a prerequisite before a return to business as usual, hedge funds and their operation have been the subject of much forensic analysis. And if leverage has been critical to the rise of the hedge fund, leverage is also seen as key to the woes of the global economy. And for many, connection between the two is no coincidence.
We don't know, for some reason, the politicians, especially in Europe, this was in America, have gotten to be in their bonnet about hedge funds. Okay, they are institutions where rich people place large bets, but they are not at the center of this crisis. They have not materially contributed to it, and they've actually taken their medicine, and half of them have gone out of business. and they haven't held up their hands for the taxpayer. So they have played the rough casino-like financial market game the way it's supposed to be played. They will undoubtedly be regulated more tightly as part of this general, if it moves, stop it attitude towards regulation that politicians espouse. But the original proposals of the Commission in this regard are likely to be watered down quite considerably.
As people look for global standards to help them make key decisions, there are changes afoot internationally that are likely to have a significant impact.
We spent a lot of time today talking about the evolving global regulatory environment, and particularly the G20, what's happening there, and some of the key announcements they made in the recent months, and really focused on better risk management, focused on better liquidity and capital, focused on accountability. And in particular, I was very pleased. He talked about the importance of global accounting standards as well. I think it's critically important as the world globalizes, and we've proven by this crisis how interconnected we are. They have a common global language to talk about business. And IFRS and the convergence to a global accounting standard, I think, is critical to long-term sustainability.
Another practice to come under the microscope has been short selling, and while proponents have argued its merits to expose financial weakness, for others undermining asset values and increase volatility in capital flows may more favour the one-off speculator than the regular financial trader.
I think that at the end of the day, someone short selling a stock will only make money if they're right. And they'll only be right if the business model of the business that they're selling is not robust. If it's not robust, then it shouldn't really exist. And therefore, I think that that's fair game. I think, in spotting that some of the bank business models weren't robust, it's very interesting that, some of the ones that turned out to be very weak were shorted. But a bank like HSBC, which has been very strong and managed itself properly, wasn't a victim of hedge fund selling at all, or to any material degree. I think, it's a tremendous cleansing process for the market if less than robust business models can't survive, and shorting helps that. And I think people who run those business models have to accept that as a fact of life.
Indeed, not confined to hedge funds, a decrease in leverage, an increase in liquidity and a tighter capital ratio structure are expected to all be features of the new financial landscape. But what effect will this have, both on the financial sector and the wider economy?
Increasingly, the financial business of the world, the expansion thereof will occur in emerging countries, which are underserved financially. They will also increasingly be the providers of savings to the world, the ultimate capital to the world. So if we are going to survive, a large part of what we have to do is to plug into the new emerging centers and become an essential part of their business model. And that means particularly Asia.
With a host of world leaders exchanging their perspectives and expounding divergent analyses, they were at least agreed that in the main this has been a once-in-a-lifetime calamity, and recalibrating the fundamentals of the free market economy will be central to achieve a sustained period of international growth.
Well, we have to tighten our belts. Consumers have to spend less to save more. The government will have to reduce the budget deficit by raising taxes and cutting spending. The banks will have to reduce their leverage and be involved in less risky activities. So it's going to be a hard slog. The economy is not going to go very fast, but at least we can avoid the next leverage and debt crisis.
Of course, consensus will be required before we begin to establish a new framework. But whether this will involve a two-tier regulatory system between Europe and the US and UK has yet to be resolved.
If we have the domain of the market and the domain over which these financial giants can roam, exceeding the domain of control and supervision, you're asking for disasters. We need agreement on global standards, preferably global regulator for border-crossing financial institutions. I mean, local things can be dealt with locally, but if it crosses borders, there should be an international regulatory supervisory entity that follows it.
No doubt the timing of an event is often critical to its significance, and waiting for an appropriate time when the shape of financial regulation could be seen through the financial mist made it all the more informative for attendees.
And we thought that by this stage of the year, perhaps there would be a little bit more certainty arising as to what the issues were, what the challenges were going to be, and that it would be a good time to have a debate and a discussion, and a pretty well-populated group of international high-quality speakers coming to Dublin to contribute to a debate, to provoke thought, and to help people in this environment actually come to decisions that will be relevant in driving their own organisations and their future direction. And also we thought that by having those people here in Ireland, they could see what's happening in Ireland, see what's happening in the domestic environment, see what's happening in the international financial services market in Ireland, and see the quality of the people who are actually engaged in the business here, and would be able to take that message back to places around the world.
As if needing more evidence that the world is truly a global village, the demise of Lehman Brothers sent shockwaves that rippled through the streets of all financial centres across the world. Here in Dublin, one of the leading financial centres in Europe, the International Financial Services Summit debated the consequences and next steps in depth. While there wasn't agreement on every issue, it certainly gave policymakers and business leaders alike a highly valuable roadmap on the big decisions that lie ahead in 2010. This is Barry Keane for Ireland on Business at the International Financial Services Summit here in Dublin.